The other three banks, David, that you mentioned, Signature, Silicon Valley Bank, and Silvergate, all had very traditional liquidity crises, right? We talked about this last week, which is duration mismatching, where you have depositors who want their money today, but you have assets that mature in 10 years. And as a result, you have huge unrealized losses if you all of a sudden cash them out today versus waiting 10 years. I think what's happening at First Republic is really just about making sure that that loan book and the depositors can get parked into a combination set of banks that can take care of the balance sheet so that there are no more liquidity issues. At Credit Suisse, they have an enormous amount of liquidity. What that was I think a lot of speculation around whether they would default on their bonds or whether they would theoretically need more liquidity. But the balance sheet itself was not only liquid, but also very solvent. So I think that was just more of a panicky reaction to comments from a 9.9% shareholder who just said that they can't put in any more equity. But even then, I went back, this is the chairman of the Saudi National Bank. He was asked on Bloomberg, would you give Credit Suisse more money? And he had a very reasonable answer, but it was snapshotted in a very awkward way. The first sentence was, under no circumstances would he do that. Okay, now if you stop there, you could be panicked. But the rest of it made a lot of sense, which is he said, look, in Saudi Arabia, if we go above 10%, we have to go through regulatory approvals domestically, and there are regulatory approvals abroad. That's a big hill to climb, and all of a sudden, it no longer becomes a financial investment. It becomes a somewhat political investment. And so we're very happy at 9.9%. That was the totality of his statement, but if you just cherry pick the first 45 seconds and ran with it, which people on the internet did, this is sort of what caused that second level wave panic at a GSIB. And then the Swiss National Bank stepped in, and I think that panic has largely gone. Okay, so what is the real issue? The issue, again, is I think we have had a bit of supervisory failure here, right? Because we all know this in any industry. If you let capitalism go totally unchecked, shareholders will demand immediate profits today. It happens in every industry, except in ones where you can basically gamble on future profits, and that's what tech does. But every other shareholder in every other asset class demands money today, and that's the same for banks. The problem is the banks are a highly regulated business. They are supposed to be supervised by the regulators. And this is a very clear example where why is there not a real-time spreadsheet? I mean, this is not complicated stuff where assets and liabilities and duration mismatching can be known on a real-time basis, where the San Francisco Fed, Mary Daly, should have a report that's escalated to her when SVB got over their ski tips, which they did in Q4 of 2022. So I think the real question that has to be examined is, where were these folks for the last 4 months when they could have done something, not just about this, but rules in general for all banks that are not the GSIBs? And I think that's a very important question that politicians need to get to the root of. I think the VC, the critique is specific to Silicon Valley Bank, because I think, and this article was in the Wall Street Journal, but what it shows is a really complicated, intertwined relationship between VCs and Silicon Valley Bank, where, you know, VCs were given very cheap interest rate loans. They were given GP call lines of credit. They were given LP lines of credit. And then those same VCs would be directing their companies to put their deposits inside of SVB, who would then take those deposits and buy risk. Yeah. And while the reality is all of this stuff will come to light, because I think it will get exposed as we go through congressional hearings on all of this. But I think pointing the finger at VCs in this specific case is somewhat warranted, because there was a little bit of people working in lockstep together, and there was a lack of functional responsibility around how to be a true fiduciary. So if you come to a board and your founder is 22 years old and you give that person $15 or $20 million, I think it makes a fair amount of sense that you are supposed to be the more sophisticated financial person in that room. And if you have incentives that aren't properly disclosed to that CEO, and now a set of decisions are made, I think that there should be some accountability for that, or at least some exploration of why that happened. So imagine a situation, you go and start a fund, Silicon Valley Bank comes to you and says, let me be a limited partner and invest with you. Let me give you some amount of money. I don't know where that money comes from Silicon Valley Bank, but well, let's be realistic. More like 25, 50 million, 100 million. Okay, this is a lot of money. Okay. So $1 million kind of is whitewashing this problem. So you give them a reasonable amount of money. They're like, wow, I have tremendous loyalty for you. Thank you. Well, do you need anything else? Do you need personal loans? Do you need lines of credit for your business? Sure, why not? I take those too. And invariably on the back end now, your loyalty obviously builds up. Again, none of this is wrong, but this is what's happening. And then you tell your companies to keep your deposits there. Maybe the cash management program is not as strong as it would have been if you were more circumspect and you didn't have those incentives to direct people to one institution only. In any other part of the market, so in the public markets as an example, there is such a bar for disclosure. Okay, and I cannot stress this to you enough. Related party transactions, all of this stuff, we have to tell everything, not just for us, but even if our sister or brother or mother may have a transaction with an entity that we're doing a deal with. And it just isn't the case in private markets. And so it's not to say that anything untoward happened, but when people point the finger at VCs, I think they are pointing to this whole set of issues and asking the question, shouldn't there have been more disclosure and transparency around it? And now that this has come to pass, shouldn't we explore it? And I think that's what the Wall Street Journal did. They started pulling on this sweater thread. And my guess is that you're going to find a whole ball of yarn at the end of it. So what the Fed did this weekend is essentially create a buyer of last resort again. Now, how did they do this? So all of these banks basically have assets that they bought for $1 and are now worth 95 cents. And that's what's creating this whole issue, or 80 cents or 85 cents. You pick the number, but they're not worth the $1 that they bought. What the Fed basically said is, okay, give me that asset, give me that bond. I will value it at $1 and I will give you $1 as a loan and you will pay me interest. And the interest rate, I think, is what's called OIS, and they added 10 basis points on top. So I think it's about 4.9%. So what it allows all of these banks, and if you take all of the banks that are not the top 4 in America, so the top 4 are JP Morgan, B of A, Citi, and Wells. So just ignore those for 1 second. The other N banks, if you look at all of the assets that are underwater because of all the rate hikes that Sachs talked about, and you add up all those losses, that is about $2 trillion. And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be one-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion, because now the incentive, if you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries that are yielding much more than what your old treasuries were yielding. And I think that's the arbitrage that we've unfortunately created. And the other question now, though, however, is what does that mean for the top 4 banks, right? Because if it's $2 trillion for everybody else but the top 4, what's the gap for the top 4? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop. And then, as Friedberg said, these checks always come due. What do we do in a year? Because in a year, the problem is the only way to make the banks in a position to repay this much money in 1 year is to cut interest rates so massively that these assets massively inflate, and now all of a sudden you're in a position to cover them. As far as I can tell, all we've done is we've kicked the can down the road for a year. But I do think it's important for people to realize this doesn't solve the problem. It just means that mark your calendar for a year from now. We have a problem on March 15th, 2024, because all those folks that took money, what do we do? That every bank that's supervised by the Fed has a dashboard that has all of the key levers that allows what you said, Jason, to happen, which is a real-time mark-to-market. Should they not be disclosed to shareholders? That's a different discussion. But the regulators should have 100% transparency into how these organizations run, because as Sachs said, They are an enormously critical institution that at best case after this fiasco, what we've realized is very poorly misunderstood by consumers. And that at the worst case is being mismarketed to us.